After studying this module, you shall be able to learn about alternative exchange rate systems, know historical overview of the international financial system, understand the current international financial system, evaluate international financial competitiveness. International monetary system comprises of certain financial payments, practices, settlements, institutions and relations that basically influence the international trade all over the world. This system also facilitates international liquidity. Certain kinds of economic and financial transactions that occur between different countries need some kind of arrangements that might govern international payments, which in turn form the substance of international monetary system. The system assists in making payments to cover transactions, offer a stable unit of account and also provides proper mechanism for deferred payments. Thus, international monetary system is the system within which countries borrow, lend, sell and make payments across international frontiers. Alternative exchange rate system. The significance of exchange rates lies in determining international flow of goods and capital and certain levels of economic well-being. The alternative exchange rate system are discussed as follows. First, fixed exchange rate system. Under the fixed exchange rate systems, governments are focused of maintaining a fixed rate, which is also known as a target exchange rate. The two common fixed exchange rate systems that have been embraced are gold standard and gold exchange standard. Gold standard. Under gold standard, each country has to establish the rate at which its currency could be converted to a weight of gold. For instance, if the Swiss Central Bank fixes the price of gold at CHF 100 per ounce, it effectively stands ready to buy and sell gold at this rate. The same happens for the United States if the US Bank fixes the price of gold at USD 20 per ounce. Thus, the exchange rate is simply the ratio of the two prices. CHF 100 by USD 20 signifies the exchange rate of CHF for USD 1 or USD 20 per CHF 100 for an exchange rate of USD 0.20 for CHF 1. However, arbitrage opportunities do exist if there are some deviations. The arbitrage process continues till the original equilibrium is maintained. External disequilibrium is often removed through a process which is known as price PC flow under gold standard. Price PC flow implies that disequilibrium in balance of payment will be adjusted through adjustments in the country's money supply. For instance, suppose that United States face trade deficit which results in outflow of gold for trade settlement, thus diminishing the money supply within the country. The deflation in the wake of reduction in money supply would ultimately make the exports competitive, which in turn remove the trade deficit on this account. The gold exchange standard. The gold standard ended its operations eventually under the depression of 1929-33. The gold exchange standard replaced the gold standard in the Bretton Woods Agreement of 1944. Under this agreement, the gold prices were fixed at USD 35 per ounce and the United States promised to exchange dollars for gold at this price. On the other hand, other countries pledged to exchange their currencies for dollars at fixed exchange rate. A new international monetary system was created as a result of Bretton Woods Agreement, New Hampshire in 1944. All participants in this exchange rate system were obliged to maintain their currencies within 1% of par value. This could happen either by buying or selling of dollar or gold to maintain the exchange rate. Under Bretton Woods system, each currency was tied to dollar directly or indirectly. It was the responsibility of United States to have price stability. The adjustment procedure to balance of payment disequilibrium under the gold exchange standard is similar to the procedure under the gold standard. However, when a balance of payment problem became a continuous problem and could not be sorted through monetary and fiscal policies, then the IMF should ask for devaluation. The system created a fixed exchange rate system, but as there was discontinuous adjustment to exchange rates, the system became known as adjustable peg. Although the adjustment procedure is exactly the same as under the gold standard, the gold exchange standard theoretically made it possible to regulate the adjustment procedure in terms of international disequilibrium by expanding or contracting the supply of international liquidities through changes in US monetary policy. Shortcomings of fixed exchange rate system. As the fixed rate system show their dependent behavior on the monetary authorities to obey the rules, many governments avoid it because of the bad consequences of paying by the rules implied by the adjusted procedure. It is mainly the central bank which plays a crucial role in neutralizing the reduction in the money base with the increase in credit to the economy. Neutralizing the decrease in money supply means perpetuating the balance of payments deficit and can be continued only as long as central banks' reserve hold out. Neutralizing the increase in the money supply means perpetuating the balance of payment surplus and can be continued as long as the reserves are accumulated by the government. Although Bretton Woods system stabilized the exchange rates, but there were certain shortcomings. The adjustable peg system was considered highly rigid and many member countries had suffered losses in the form of misallocation of resources. This system also did not take into consideration the MNC's activities, which necessitated large flow of funds among different countries that also influenced exchange rate changes. The main characteristic of this system was confidence, which was considered the root of the system. As confidence was shaken, the system was collapsed. Second is the flexible exchange rate system. Fixed exchange rate system usually depend upon the automatic adjustment procedure to operate properly, which is set off by changes in the money supply. There is generally no requirement to go through the adjustment procedure accompanied by a decrease or increase in the money supply if exchange rate adjusts freely to the supply and demand of one currency for another. In order to escape from the shortcomings which is imposed on macroeconomic policy making under the discipline of balance of payment, flexible exchange rates were seen by the believers of the monetary approach. Advantages of flexible exchange rate system. First, under this system, the need for foreign reserves is reduced as there is possibility of diminishing the cost of holding reserves. Second, there is another possibility of reducing the control on international trade such as tariff, subsidies, quotas, etc. Arguments for flexible exchange rate system. First, the first argument is that flexible rates would permit a high degree of autonomy in domestic economy policy while guaranteeing the balance of payment equilibrium. However, immediate reflection of disequilibrium would be there having no consequence on prices, output, resource allocation and consumption. But this argument is unfair because exchange rate change cause relative changes in price, redistribution of income, reallocation of resources and variations in the composition of output and consumption. Second, another argument arises that domestic economy is protected from bad economic policy in the rest of the world. For instance, in a fixed exchange rate system, France is considered a major trading partner of Germany, which permits excess growth in its money supply. This in turn causes French balance of trade deficit with Germany. Thus, Germany is affected by France's profligacy being other things constant. Its corresponding trade surplus will lead to an increase in the German money supply and set off the adjustment procedure. However, it is argued that flexible exchange rate system would protect Germany in this case. In the 1980s, when France pursued this policy, then France was obliged to devalue the franc and rein in its monetary policy. Instead of exporting its inflation and bad monetary policy to Germany, Germany exported its good monetary policy and price stability to France. Third, the argument against the flexible exchange rate system also concerned the instability of the exchange rates, uncertainty and speculation. But it is often seen that such instability is caused by the forces of demand and supply which normally exist in the fixed exchange rate system. As the exchange risk can be covered in the forward market, hence speculative profits of the short-term nature would be reduced because the spot rate would move in line with the forward rate. Under the flexible rate system, the economy is also exposed to cyclical pressures, thereby diminishing its access to the foreign capital or at least increase the capital that must be paid for it. Next, historical overview of the international financial system. The gold standard era of 1880 till 1931. Gold standard was seen by most of the trading partners in 1880s. However, the period between 1880 and 1914 was marked by free flow of labor, capital and goods across borders, rapid economic growth, stable prices and exchange rates when World War I brought an end to the gold standard. Then there was a period of flexible exchange rate, but by 1926, the gold standard was put in power again in order to bring down inflation. Unfortunately, many governments were not up to the discipline that the gold standard implied and thus failed to follow the rules. But in 1931, when France made an announcement that sterling would no longer be accepted and hence made efforts to convert its existing sterling holdings into gold, no choice is left for Britain to make sterling inconvertible. On the other hand, other countries holding sterling followed suit. As the base of the gold standard is to exchange currencies for gold at a fixed rate, thus the gold standard was declared. Flexible exchange rate system returned in the subsequent period. This period also saw a return to beggar thy neighbor policies of competitive devaluations and increased protective barriers. Since the Great Depression of 1930 was followed by World War II, no new system was able to emerge until after the war. Bretton Woods and the gold exchange standard from 1944 till 1973. The Bretton Woods system created the gold exchange standard, which is negotiated by the Allied powers toward the end of the World War II in 1944. To this end, the International Monetary Fund, known as IMF, was created to oversee the exchange rate changes and serve as a reserve base for deficit countries. The main ingredient of the system was to make US dollar freely convertible into gold with the other currencies fixed in terms of dollars. However, for its succession, the United States is required to maintain its monetary policy with a zero or negative rate of inflation so that the dollar prices of gold would remain at or below USD 35 per ounce. But the Bretton Woods collapsed as the US monetary authorities failed to perform this duty. By 1962, all efforts were made by the United States, thereby prohibiting the US citizens from holding gold abroad as well as at home and issue non-marketable securities in lieu of redeeming gold. By 1968, the point had reached where a two-tiered system for gold pricing was established. The official price was reserved for the official transactions between the central bank, and the private market price would be allowed to find its own level. So long the private market price was far above the official price of USD 35 and the dollar continued until on 15th August 1971, President Nixon seized dollar convertibility even for the central banks. Smithsonian Agreement was announced in December, under which devaluation of dollar was fixed to USD 38 per ounce of gold, other currencies revalued relative to the dollar. Moreover, the intervention bands were increased from plus or minus 1% to plus or minus 2.25%. By 1973, this system was no longer sustainable and the world entered the arena of flexible exchange rates. Flexible exchange rates from 1973 to 85. Most governments had already freed themselves from the monetary discipline of the fixed exchange rate when the world economy was hit by the higher oil price between 1973 and 1974. Most countries, including poor and developing countries, financed their balance of payment deficits by borrowing large amount on the international financial markets that were simultaneously recycling the opaque balance of payment surplus. This led to the international debt crisis of 1980. In 1978, IMF gold was also demonetized in the sense half of the gold was to return to its members and other half was to be sold. The proceeds were to be used for the development in the poor countries. In 1979, the countries of the European Community created the European monetary system with the aim to promote exchange rate stability among their currencies. From 1976 to 78, the dollar lost 12% of its value compared to the special drawing rights. Lastly, in 1979, Fed focused only on controlling the money supply rather than on stabilizing the interest rate. The goal was, however, achieved to curb inflation. From 1979 till 84, the dollar gained over 34% against the SDR and the dollar inflation fell to close to 4%. As dollar inflation fell, dollar interest rate remained high. This influenced most of the developing countries to rely on a limited number of primary products for their foreign exchange earnings. Unfortunately, most of their loans were in dollars where interest rates remained high. Hence, a higher percentage of their supply of foreign exchange went to service their foreign debt, leaving less to buy the imports necessary to keep their economies running. 1985 to date, that is the era of the managed float. The dollar had hit its peak by 1985. In September 1985, the group of five, the United States, France, Japan, Great Britain and West Germany, came up with the Plaza Agreement in New York, where their focus was to bring down the value of the dollar against the other major currencies. This worked well in the sense dollar fell close to 11% of its SDR value in 1985. The dollar lost another 10% in 1986. The group of seven, now including Canada and Italy, known as G7, reconvened in February 1987 in Paris and negotiated the Lower Accord, thereby slowing down the dollar's fall by synchronizing their economic policies and simultaneously supporting the dollar on the exchange markets. The United States decided to cut the budget deficit and diminish the growth rate of the money supply, whereas Germany and Japan decided to stimulate their economies. However, the budget cuts were not resulting and stimulatory measures were not imminent by Germany and Japan. The policy synchronization was collapsed when worldwide stock market crashed in October 1987. The markets were flooded with the dollars and the dollar fell close to 10% against the SDR in the last quarter of 1987. Next is the current international financial system. The current international financial system has mainly three pillars. First, dollar is still considered the principal currency in international transactions, but its dominance is no longer taken for granted. Second, the European community is essentially showing its importance. And third, the Bretton Woods system is dead, but IMF, which is considered its child, has evolved and gained importance. International Monetary Fund, known as IMF. IMF is one of the most important players of the current international financial system, whose purpose was to provide financial assistance to the member countries facing balance of payment difficulties. The main role of IMF was to promote exchange rate stability, help in the development of a multilateral system of payments in regard of transactions between members, and also to impart confidence to members by making the funds resources available to them. It was necessary for a member to submit a par value of its currency in gold or in US dollars. However, the value could vary by 1% in either way, and any changes should be verified by the IMF. The resources the IMF came from the subscriptions, which were determined on the basis of the members' relative economic size. 25% of the quota was to be paid in gold and the rest in the member's domestic currency. Generally, member could borrow up to the first 25% of the quota, which was called the gold tranche. In 1963, IMF introduced the compensating financing facility to assist the countries having inadequate foreign exchange reserves resulting from events such as crop failure. It also set up the oil facility in 1974 to assist oil importing developing countries. It also played a crucial role in creating the Trust Fund of 1976 to permit the sale of gold for the development of third world countries. In 1978, IMF's gold was demonetized, and in 1980 it played a key role in the international financial system in resolving the debt crisis. European Economic and Monetary Union. Another major player in the international financial system is European Union, that is EU, formerly known as the European Community, EC. It ranks the United States and Japan as a giant of the world trade. Its importance grew from the post-war recognition of necessity for European economic cooperation. The first step was the creation of the Organization for European Economic Cooperation, known as OEEC, in 1948 to administer the Marshall Plan. The next step was the development by Belgium, France, Italy, Luxembourg, the Netherlands and the West Germany of the European Coal and Steel Community, known as ESCS, in 1952 to create a common market in steel and coal. However, the major initiative to today's economic integration was the Treaty of Rome, which was signed on 25th March 1957 by similar countries. When Bretton Woods system collapsed in 1971, the EC countries along with the United Kingdom and Denmark, who were to join the EC in 1973, agreed to maintain their currencies within a narrow band, that is 2.25% than the 4.5% allowed in the Smithsonian Agreement. This was known as the snake in the tunnel because the EC currencies floated against other currencies like dollar. The tragedy of 1970s scaled down the snake from 8 to 4 participants, namely West Germany, the Netherlands, Belgium and Denmark. In 1979, the European monetary system was launched, led by the West Germany and France. The main aim of EMS was to establish a zone of monetary stability in Europe. The initial phase of Economic and Monetary Union, that is EMU, began in July 1990. The second phase began with the establishment of European Monetary Institute. In 1998, the European Central Bank, known as ECB, was established. Its directorate, named the European System of Central Banks, that is ESCB, started issuing euros. The third phase was implemented on 1st January 1999, when this marked the end of the ECU as a basket currency and the creation of euro as a full-fledged currency. The currencies of EMU members were exchanged at the exchange rate fixed on 1st January 1990 from 1999 to 2000. All this was done to replace the individual currencies with the euro, which was finally completed on 1st July 2002. Next is evaluating international financial competitiveness. The concept of international financial competitiveness is used in measuring countries' macroeconomic performance. It contrasts salient economic features between country and its trading partners that can help to explain the international trade. Since the beginning of 1980s, drastic changes have been seen by OECD countries in respect to their prices, cost and exchange rates. The influence of second oil shock during this period on countries was entirely different, keeping in mind their dependence on external energy supplies and their relative cycle positions. The steep rise in inflation in the period of oil shock has long-lasting effects on some countries. There have been massive amount of changes in the US dollar against other currencies. Between the period of 1980 and 1985, the US dollar exchange rate doubled against ECU. However, it depreciated by nearly 70%, but the EMS currencies fluctuated less widely against each other during this period. Hence, these large movements in prices, cost and exchange rates have all influenced international competitive position of OECD countries. These in turn associated with major changes in trade balances. In general, the appreciation of dollar in the first half of the decade is one factor which is responsible for the emergence of a large US current account deficit. Since 1985, depreciation in the dollar has not yet brought about a corresponding adjustment on the trade front. This problem was focused on the question of how international financial competitiveness should be measured. Thus, there are some indicators that can be used to settle the international debts, which in turn measure the international liquidity. These are described as follows. First is the monetary gold, which is held by the authorities as a financial asset. Second is the SDR, which are the reserves created by the IMF as bookkeeping entries and credited to the accounts of IMF members countries according to their established IMF quotas. Its value is calculated daily on the basis of basket of currencies by IMF, with each currency assigned a weight in the determination of that value. The reserve position in the IMF is the difference between each member's quota and other claims on the fund less the fund's holding of that member currency. And last is the foreign exchange, which constitute monetary authorities' claims on non-residents in the form of bank deposits, treasury bills, short-term and long-term government securities and other claims used in the event of balance of payments need without regard as to whether the claim is denominated in the currency of the debtor or creditor. Let us now summarize what we have done in this module. International monetary system is a system of certain financial payments, practices, settlements, institutions and relations that basically influence the international trade all over the world. Different alternative exchange rate systems are fixed exchange rate systems and flexible exchange rate systems. Fixed exchange rate system include gold standards and gold exchange standard. Gold standard possessed automatic mechanism for domestic price stability, stability in the exchange rate and for balance of payment adjustment. However, it could not be sustained during the First World War and was suspended. It was re-adopted after the war but again failed to prove successful in the face of changed environment. Thus, it was finally abandoned in 1930s. Gold standard was replaced by the gold exchange standard under the Bretton Woods Agreement of 1944. Fixed exchange rate systems should require strict fiscal and monetary discipline to function effectively. But the failure of the government to respect this discipline was the major flaw that killed the gold standard and the gold exchange standard. Flexible exchange rate systems require less fiscal and monetary discipline, and therefore under this system the exchange rate tends to change automatically in line with the changes in the macroeconomic variables. The exchange rate is determined by the market forces of demand and supply of a particular foreign exchange currency. Historical overview of the international financial system comprises the gold standard era of 1980 to 1931, Bretton Woods and the gold exchange standard of 1944 till 73, flexible exchange rates from 1973 to 85 and the era of managed float from 1985 till date. The main players of the current international financial systems are IMF, European Economic and Monetary Union, and the European Monetary System. International financial competitiveness is evaluated keeping in mind the indicators which are used to settle the international debts, monetary gold, SDRs, reserves, etc.